Hey, good morning, everyone. Dan Russo, Chief Market Strategist at Chaikin Analytics, bringing you Stock Market today for Friday, June 5th, 2020. Head over to chaikinanalytics.com/today to sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities were mostly lower in Thursday's trading, with the S&P 500 falling for only the second time in the past 9 sessions. Treasuries were mixed, with the curve steepening. That's a continuation of what we've been seeing for the past couple of weeks. The dollar was weaker against the euro and sterling, but stronger against the yen cross, another continuation of recent trends. Gold finished up 1.3%. WTI crude was up 30 basis points. Now, as we get to the desk this morning, futures are up about 80 basis points ahead of the non-farm payroll report for May that's due to be released at 8:30. Market here in the U.S. on track for another week of gains led by the cyclicals. Asian markets were higher overnight, with Hong Kong and South Korea up about 1.5%. European markets are stronger as well. Treasuries are weaker once again, with the curve steepening. The dollar is stronger versus the yen and the euro. Gold is down 90 basis points, and WTI crude is up 1.9% to get us going on a Friday morning. So as I take a look at the structure of the S&P 500, some stalling activity yesterday with the non-farm payrolls report for May on deck. We've kind of hit that 3110 area that we've been highlighting and saw some churning activity yesterday. Not much of a surprise to see that, as we've hit that key level that lines up with really what was the top of the interim rally after the downward thrust began. Now, support 2950 to 3000. That's the initial area of support. I have the 3000 level highlighted here. You can squint and see that the 200-day moving average is there as well at 3006. Below that, 2750 to 2850 starts to come into play. Resistance in the near term, near 3150, and then the February highs start to have to become a factor. Now, the Qs are already trading at their February highs, which is why I say that if SPY breaks 3150 here, the odds are we're going to attack the highs there as well. We are overbought in the near term, looking at that CCI, and Chaikin money flow is bullish. So overbought with bullish money flow, treading water in and around a resistance area with clearly defined support just below. Now, these support levels are important because, to me, they would keep this uptrend from the March lows intact. So I think it's important on any pullback for those to hold. Should they hold, odds are we're going to kind of continue higher and attack those February highs. I can't believe I'm saying that, but it doesn't matter what I believe. I've said it numerous times. Price action is key, and holding key levels would bolster the odds of price action continuing in the upward direction. At least that's how I'm viewing things for the time being. So let's hit our market in a minute now. What are we writing about in our note? Well, we weakened slightly as the SPY churns near the 311 mark. We hit that. The key themes point to increased risk appetite. My notes on Friday, I look at key themes and relationships about risk appetite and growth, and they are pointing to increased risk appetite as investors appear to be betting on better growth prospects. Now, in this case, better growth prospects could simply mean less bad, right? The data has been horrible from an economic perspective. We all know that. We've seen what's going on. And we've actually gotten to a point where less bad is actually better and can drive stocks higher. But with that being said, there's an area of the market that looks overbought with weak money flow that I'm highlighting in my note today, and that's the insurance stocks. And as I said, futures are higher in front of the May jobs report that will have been released by the time you are watching this show. Turning now to the major indices from a power bar perspective, continued improvement here. The Dow 5 to 5, so back to even on the Dow as it added 6 basis points yesterday. S&P 500 down slightly, 110 bulls to 80 bears there. NASDAQ was an underperformer. It's part of that rotation that's playing out. 35 to 9 bulls to bears in that group. Small caps were a slight outperformer. Again, same theme, part of the rotation. Big ratio in favor of the bulls there, 676 to 246 bulls to bears. Bonds down ticked, as you would expect in this rotation, as well as increased risk appetite. and that sent yields higher. 10-year back to about 80 basis points. Financials in that environment outperforming a bit, up 2.18% yesterday, 18-8 bulls to bears on the power bar ratio. So according to the Chaikin power bar, small cap stocks and large cap stocks are bullish. Major markets across the board are mixed. Let's hit our stock of the day now. I said we're starting to see some weakness or potential weakness in the insurance stock. So we are highlighting Assured Guarantee. AGO, the ticker symbol there, has a bearish Chaikin power gauge rating, is in a weak trend below the declining long-term trend line. Now, the insurance group does have a bullish power bar ratio, but it's very overbought with very bearish money flow. So I wanted to see an opportunity for potential bearish opposition or idea, given that we are overbought in the markets, given that the insurance group is overbought and still bearish, right? So if we take a look at AGO, what I see is clearly defined ranges here, right? We have a triangle pattern. It's consolidating. We're getting near the apex of the triangle as the stock is overbought, oversold indicator heading lower, money flow bearish, right? Severely underperforming the market. Odds favor a resolution to the downside here. Odds favor, not guaranteed, but I think the setup here looks compelling, can be taken in a risk managed way, right? Or a clearly risk defined way if you're interested. But I think insurance stocks have potential to be vulnerable here. So AGO looks like a compelling opportunity on the bearish side based on my work. Let's hit our sector tracker now. The movement of the major sectors over the last 5 days. There's your energy at the top of the list, your cyclical rotation playing out. Energy, fins, industrials, materials. Nothing screams cyclical rotation like those four groups being at the top of the list. Now, we've been highlighting for a few weeks. Materials has been our preferred area to play this rotation, as out of these four sectors, it's the only one that does not have a bearish ETF rating, right? The rating there is neutral. We've highlighted materials a few times on this show and in our notes. In the middle of the road, discretionary REITs and technology, as well as utilities. And then the laggards, comms, staples, and healthcare. Remember, we've been kind of hitting that drum on healthcare for a little while now, as we've started to see over the past few weeks some relative weakness that warranted attention, and largely that continues to play out. So with that in mind, our industry in focus is healthcare services, which has been a laggard over the past 6 months. It's underperformed the S&P 500 by 2.2%, but the power bar ratio is very strong, 20-3 bulls to bears. Currently ranked number 4 of 21 subsectors and moved down 3 slots over the past week. So some names there that might be interesting: Triple S Management, GTS, CVS, Health Corp, CVS, and McKesson, MCK, all with very bullish ratings. I think healthcare is one of those broad groups, and healthcare is one of those broad groups where you really have to drill down on the different areas, right? Pharma, obviously different from services and med tech, and biotech is its own animal. So I think it makes sense to pay attention there. But as I see, healthcare services, XHS, has a very bullish rating and a strong trend. Now, what I do see is some stalling activity up here near resistance as the fund became overbought. Now, what I don't love is this intensely bearish money flow, right? It's been it's outperforming over the past 6 months. So bullish, outperforming, but overbought with bearish money flow, lining up with a sector that's showing some signs of relative weakness. I think it's interesting. I think there were probably better opportunities out there. I do think that, this is kind of ripe for a pullback, and a pullback towards the $65 area that produces an oversold condition while still outperforming maybe sets up a better opportunity in an area like this. Finally, what's trending? American Airlines provided an update. Investors like what they heard. They're up 41%. UAL and DAL went along for the ride. And if you look at the charts of these stocks, you can see near-term breakouts from consolidation around the lows. Capri, no real news to send that stock higher by 12%. Helmerich and Payne, part of that energy group that's been strong over the past 5 days of trading, up nearly 10%. Now, in the event of full disclosure, I am long call options on DAL. A couple of days ago, I did see the breakout that was playing out for these stocks. You saw, the initial thrust lower and then a consolidation near the lows that has, at least in the near term, broken from that consolidation pattern. I took an opportunity there. to take some call options in DAL, which I still hold. So I always like to give full disclosure if I'm talking about a name and I do have a position to give you the courtesy of letting you know where I stand on it if I do have a position. And that's what I've done here at DAL. Loser side of the board, DR Horton, no real news. INSEE, small and mid-cap biotechs. Mid-cap biotechs were under pressure yesterday. INSEE down 5%. Edwards, no real news to take 5% out of that stock. SJM gave some guidance that disappointed the street, down 4.8%. SBAC was given a buy rating at Deutsche Bank, but investors didn't care. They took 4.5% out of that stock yesterday. Let's dive into the charts. What's driving the rotation trade and how likely is it to persist is the biggest question that I've been getting of late. So the copper to gold ratio is the one that I'm watching. Copper to gold to me is a proxy for investor expectations of global growth, right? It's been in a clear downtrend really for over 2 years. However, we've seen a near-term pickup in this copper to gold ratio coinciding with a series of higher lows by the RSI. Right now, a similar dynamic played out in the fourth quarter of last year that got investors excited about a rotation that largely coincided with signing of phase 1 of the U.S.-China trade deal. It quickly gave way at the start of the year and then accelerated with COVID-19, and now it's trying to rally once again. So this is one of the key data points that I'd be watching for signs that that rotation is likely to continue, right? We've been talking about the materials. You're looking for signs in the other groups, and you're looking for signs across asset classes. So far, this is confirming, but still a lot of work to do as far as I'm concerned. Still very much below the declining 200-day moving average. But as this is played out, what you'll see is that the 10-year yield, the TNX at the bottom of the chart, has kind of been bumping along the lows and started to lift its head a bit. Now back to 82 basis points, right? All part of the same theme, all key data points you should be focused on if you're paying attention to this rotation trade. If you see these start to reverse, you have to start to ask yourself if that rotation trade still has legs. Right now, it appears to have legs. We will continue to monitor the longer term trends, right? The question or the jury is still out as to whether this is simply a counter trend rally similar to what we've seen a few times over the past year, or if it's the start of something bigger. And we'll continue to monitor that situation closely. As that has played out, here's another one of the data points that I think you need to be paying attention to: growth versus value, right? Taking a look at the iShares core US growth versus core US value, you can see a topping out pattern that was unconfirmed by momentum. These highs here in May, early May, were met with lower highs by the RSI. Now, I've been talking about this divergence in my note for the past 3 weeks, and we've been saying it does not make sense to chase growth, right? That has largely been the right call as this rotation has played out, right? So we're going to, it's still in an uptrend, right? But we don't want to chase. Okay, we want to give this time to play out, see if potentially support holds here on a relative basis, see if the uptrend holds, see if we get a rebound in the RSI after holding within bullish ranges. And we want to see the Qs start to outperform relative to the SPY, which they've been lagging for the past few weeks as well. So further confirmation of this near-term rotation trade. And then finally, we do appear to have risk-on activity in the marketplace. My note today goes into a lot of the data points that point to this type of risk-on activity. I'm going to highlight just one of them. It's high beta versus low volatility. If you are in a risk-on kind of mood, chances are you are going to favor the stocks that are likely to outperform the market, i.e. go up more than the market. And that's largely been the case here since the March low, as high beta has been outperforming low volatility to the point where we've now taken out resistance in a move that was confirmed by momentum as the RSI has appeared to shift to bullish ranges, right? So all part of the same trade, all data points that you should be watching. If you're paying attention to these cyclical names that are beginning to outperform, if you're trading in them, these are the signposts. These are the data points that you should be monitoring to let you know that that trade is likely to persist or could be turning. If you start to see these data points roll over and you're getting stopped out of your trades, you know that the rotation could be ending. That'll wrap us up for today. Take us for a test drive. Have a great weekend. Be well, be safe. I'll see you Monday.